Hey guys, it's Wayne Scully, tax strategist. I provide small business advisory and tax consulting services. As a real estate tax planner, I'm focused on providing solutions to real estate investors in the New York tri-state area. My firm provides tax compliance, business consulting, and high-value tax planning strategies to save you thousands of dollars. Now, I wish I was on the beach. You can see my background right now. I wish I was right there, but unfortunately, I'm not. I'm here with you guys. If you're in the Northeast or along the Eastern Seaboard, you're probably freezing, right? Yeah, lower than normal temperatures, from Florida all the way up to Maine or maybe beyond that. In any event, I wanted to take a couple of minutes to talk a little bit about um, rental income. Rental income, right? There are probably 10 million returns with some sort of rental income on them. I am talking residential rental here, but in general, a lot of these rules apply to other types of rental, like renting personal property. But let's get at it, okay? What is rental income? Rental income is basically, amounts received for renting something. You allow someone to use or occupy your property. Whatever you get from that person is rental income, okay? Gross, anyway. And if you're on the cash basis of accounting or cash method, um, meaning if you get the income and you're supposed to report it right away, even if you haven't earned the income. So let's say someone gives you a check December 31st, it actually belongs in your December or that year's tax return. All right, so if you get a check, let's say December 30th or 31st of, let's say 2021, that income actually belongs in 2021, right? However, I understand sometimes the banks, they don't process that. It doesn't show up on your bank account until it's processed. So there may be some delay, but technically speaking, if you receive money on your cash basis, it's considered rental income the day you receive it. Now, let's talk a little bit about some other nuanced things when it comes to rental income. Let's say someone, instead of giving you cash, they provide services, or they give you property in lieu of giving you cash. Well, you're supposed to get the fair market value of that property, determine the fair market value, and that's what you put in your tax return as gross income from rent. Okay. What about canceling a lease? You want a tenant out, they want to be out, they pay you off for the rest of the lease term or some portion of that in lieu of staying. Well, that's also rental income. It's considered rent. And let's say the tenant fixes something in the home on your behalf. You should have fixed it. They couldn't wait. There's a problem. It's cold right now. We have problems with heating, and someone decides to call in a plumber or some HVAC person to handle the heating situation or lack thereof. That money they spent, unless you reimburse them, you have evidence to show that, that's considered rental income to you. Taxpayer receiving that money or receiving the benefit of that service. Security deposits. If it's a refundable security deposit, then it's not income, assuming it's refunded. If it's not refunded, even part or in whole, because for whatever reason the tenant didn't do what they were supposed to do, and you had to evict them early, or if they stayed in the lease and whatever, there's property damage or something, and you keep the deposit, that's considered income in the year you receive it, or in the year they moved out or whatever happened, right? So you have to include it in income. Now, lease with the option to buy. If the agreement, if the rental agreement says, hey, tenant can buy the property, the payments received under the agreement are generally rental income. So if it's a lease with an option to buy, they lease it today, but in the future they have the option to buy it. During the course of those payments, during the lease period, those payments are going to be considered income. Okay. What if you rent your home for, say, 10 days of the year? Only 10 days, just 10 days. You live in the Pocono area, or you have a home in the Pocono area, or you have a home in out in that's Suffolk County, Long Island, then it's a pretty popular spot for people to vacation in the summertime. You rent it for, say, 10 days or 12 days or something like that. Certainly if it's less than 15 days, surprisingly enough, they give us a break. There's no income to report. You also can't deduct the expenses, right? However, the normal expenses you would deduct on a Schedule A, like the mortgage interest or the real estate taxes on that property, you would still be able to deduct them there. You just can't deduct them on with respect to the rental property, okay? Because there's no rent, because that money is pretty much tax-free, right? Now, let's say you use a management company for reporting purposes or for management purposes, managing of the property. They're supposed to issue a 1099 miscellaneous, 1099 MISC in caps, and report that on box 1 of that form. If they do that, which they're supposed to do that, then really that amount could be net of the expenses that they incurred, right? A lot of times property managers, they pay certain expenses for you. They get third parties in to do work while you're absent. That's the whole point of having them, right? You're going to be out of town, or you're going to be living in another state, and you want them to manage that property for you. They will incur certain expenses. When they issue the 1099 MISC, it'll in box 1, it may show the net amount, net of the expenses they incurred to manage that property for you. What IRS says is that you need to still get the gross amount, report the gross amount as rents, and then you take your expenses or capitalize certain costs accordingly on the return, right? So they want you to break it out. If you get a 1099 for the net amount, you have to gross it up and then show those expense items individually on the tax return, okay? Now, typically tax returns for renting homes or renting real estate, if you're not in the business of renting real estate, if you're a homeowner, you're renting your property, you would report it on a Schedule E. If you're renting personal property, you're going to report it on a Schedule C. That's the general rule, okay? That's it for me, guys. Have a question about what I just talked about or some of the tax issue, give me a call. Again, my name is Wayne Scully. I'm with W. Scully CPA PC, working around the clock to save you a chock full of money, time, and stress. Make an appointment by visiting www.wscullycpa.com. That's www.wscullycpa.com, or call me toll free, 855-254-1892, okay? If you can do me a favor, please watch this video, or listen to it, if that's the case. Like, comment, share it with your friends and family and with your business associates. And I thank you very much in advance. You take care. Until next time.